You ever look at a property brochure and just think, wow, this seems way too good to be true? Well, today we're going to put one to the test. We are doing a deep dive on Sunway Mont Residences in Kuala Lumpur, treating it like a real-world investment analysis to see if that glossy promise actually holds up in reality. I mean, on paper, this place looks flawless, but, as any smart investor will tell you, the real story is almost always hiding in the details. So, the big question is this the dream investment it's cracked up to be, or is there a catch we're not seeing? Okay, so first things first, let's build the case for this property. This is the pitch, right? This is the dream scenario that gets investors all excited and ready to sign that dotted line.
And here it is, that perfect checklist. You've got a prime address in Mont'Kiara, a freehold title, which in Malaysia is absolute gold, and it's built by Sunway, a top-tier developer. Then you add in low-density living and these really cool dual-key layouts. But honestly, it's that last point that makes it a real standout.
Now, if you're not familiar, a dual-key unit is kind of like an investor's secret weapon. See, it's one property on paper, but it really functions as two separate homes. You could live in the main unit and rent out the attached studio to help pay your mortgage, or you could rent out both to different tenants. It's a fantastic way to boost your rental income and spread out your risk, all from a single asset.
And this right here is the property's ace in the hole. The fact that you can just walk to a top international school in less than 10 minutes, that is a huge, undeniable advantage. It basically locks in a very specific and very reliable group of tenants, expat families who will absolutely pay a premium for this exact convenience.
Okay, so that was the pitch. Pretty compelling, right? But now it's time to put on our analyst hats and do a serious reality check. It's time to find those hidden flaws, the stuff they definitely don't put in the glossy brochure.
So here's the first big disconnect. The marketing material will tell you all about the fantastic access to major highways, and yeah, technically that's true. But the day-to-day reality for anyone living there is just a constant battle with soul-crushing traffic just to reach those highways. This isn't just some minor annoyance, it's a huge hit to your quality of life.
And that leads to an even bigger, more long-term problem. The entire area is basically an island, completely cut off from the city's amazing rail network. As all these other neighborhoods get more and more connected, this total dependence on cars could put a real ceiling on this property's future value.
So who's actually living here? Well, the numbers tell a really interesting story. A whopping 70% are from the expatriate community, and yep, you guessed it, they're mostly families drawn in by that school. The other 30% are locals, mostly investors and professionals. Now, this heavy concentration is both the property's greatest strength and its greatest weakness.
And here's what that risk really looks like. When your rental income is so tightly connected to just one group of people, you're pretty vulnerable. I mean, what happens if big multinational companies suddenly cut their housing budgets, or if there's a change in visa policies? A little hiccup in the global economy could suddenly leave you with a very empty, very expensive apartment.
Okay, so we've seen the dream and we've seen the reality. We've got the really compelling pros and some pretty significant cons. Now it's time for the verdict. And really, it all boils down to that classic tug-of-war in property investing: yield versus growth. It's so important to get these two straight. Rental yield is the cash flow, the money that hits your bank account every month. That's your income. Capital growth, or appreciation, is how much the property's price goes up over time. That's your profit when you eventually sell. Look, very few properties are amazing at both. You usually have to make a choice. And this chart right here is the story of Sunway Mont in a nutshell. Its rental yield is high, somewhere around 5%, which is really excellent for this area. That's the income part. But its potential for capital growth, for the price to actually go up, is low. And why is that? Well, it's because the entire neighborhood is just flooded with high-rise condos, and that puts a really hard ceiling on how much prices can ever appreciate.
So here it is, the final scorecard. It gets an A for rental income, no question, that's what it was designed for. But for capital growth, it gets a C- because of that oversupply issue. The location gets a B. It's a prestigious address for sure, but it's held back by the terrible traffic and lack of trains. And the risk profile is a B-, because while the income feels safe, it's totally dependent on a very specific and kind of volatile group of tenants.
Honestly, I don't think I could say it any better than the source analysis did right here. This one sentence is the entire story. This is a property you buy to collect rent for the long haul. It is absolutely not an asset you buy hoping to flip it for a big profit in a couple of years.
And that really brings us to the final and most important takeaway. This case study isn't just about one building in Kuala Lumpur. It's about investment strategy. So the question you have to ask yourself is this: what kind of investor are you? Are you playing the long game for steady cash flow, or are you hunting for that big-time growth? Knowing that answer is the very first step to making the right choice for you.